Good evening. Great to have a packed room here once again. This is always an event we really enjoy seeing so many of you attend. So, it's kind of become a little bit of a tradition that my job is to look into the crystal ball, albeit it's typically a pretty foggy with a few little hairline cracks in it, but to give you some perspective around, what it might look like in the long run. So the first segment will be to give you an update on our perspective on what that long run outlook looks like. Now, everybody always says in the long run, I'm dead, so can't you tell me some perspective about what might happen in the nearer term? And we've always been reticent to, go on the line and say we think this or that's going to happen. In fact, really, we don't think anybody can do that specifically. But we do want to introduce some new technology that's very cool, that's a remnant of the financial crisis, that is actually giving us a tool to think about risk in a little more robust and a little more granular manner. To give you a little bit of perspective on what the range of scenarios are for given different potential economic events or global economic events that we could see in the nearer term. So we'll talk a little bit about that as well. So before we kind of get into the outlook, kind of 4 different ways that you can invest. Well, the first way is, not being a very good investor, right? Non-successfully. The second one is, you can be successful, but it's lucky. You throw a dart at the newspaper, you might hit, Apple computers, I suppose. But the third one then is, that's the, fraud or insider trading. Or, think of Madoff, and that worked, and till it didn't. And then last of all, it's taking being successful by taking a long-term disciplined approach. So those are kind of the 4 different scenarios as you look at investors and strategies over time. But I think you can kind of further distill this down to really 2, because those middle 2, lucky and fraudulent, those don't work in the long run. They are not successful. Again, Madoff could work for a while, until they hauled him off to jail. So it really leaves you with 2 strategies. Now, anybody want to guess which approach we take? All right, so yeah, we have always focused on the long term because we think that's where the money is. So that's what we're going to do here today. And before I kind of get into the numbers around what we think stocks and bonds might look like over the long run, I want to just give you a little whirlwind around the world and kind of around what's going on in the economy and geopolitics and how that then potentially rolls into a longer term outlook. So we'll start out, our little global tour in the United States, and the good news is that it's still a favorable, outlook here. A few years ago it was feeling pretty dire. You fast forward today, and I guess the best way to describe it today is we're kind of putzing along, right? Now that's not all bad. I mean, when it's going gangbusters, you're partying like crazy. The next morning you have to pay the price. When it goes up a lot, it can come down a lot. So we haven't seen the economy going crazy. It's putzing along. The unemployment keeps going down a notch here and a notch there. And the economy continues to grow. There's really kind of 3 main things that have been big drivers of that putzing along growth. One of those is that the energy trends are actually really favorable. And who would have thought we would have been saying that just a few years ago? Because, of course, they were talking about oil shortages and running out of fuel, and the fact that we were held hostage by the Middle East. But what's interesting is last year, for the first time, we became the #1 producer of oil in the world. It's even more so than Saudi Arabia. Now, we're still the largest consumer of it as well, but the path that we're on with all the fracking and all of the new technology has actually got us in a path where we are likely to become a net producer over time. So that really, not only does that mean the price at the oil pumps go down, it also changes a lot of the dynamics in politics because, we don't have to tolerate some things in the world that maybe in the past we had to in fact tolerate. So that's the first thing, and of course it's the cost of energy is a big driver to businesses, and so when the costs go down, not only do you save money on gas, but companies' profitability goes up and ability to grow enhances as well. The second thing is labor. Now, you hear about how all the good jobs are, leaving, and yeah, we got jobs, but they're maybe not the kind of jobs we used to have, and gosh, a lot of the jobs are fast food and retail. The interesting thing, it just ain't so. We've actually seen very substantive job growth in the last 4 years, about 11 million jobs. And it's not the lower quality jobs you'd think about. Actually, the areas where we had the largest growth is really in the business and professional services. So think of companies like Savant. There's only really kind of one piece on here that's red, and I don't think anybody's going to lose any sleep about that. The government's actually not employing as many people, so that's probably an okay trend. They're having to get real jobs. So the bottom line, we are seeing job growth and the kind of jobs that actually fuel the economy and provide opportunities. They do tend to be a lot of jobs in the more educated space, so it is becoming a bit more difficult if one doesn't get a college degree or graduate degree. It's a lot harder trek up the mountain. But the higher quality, higher paying jobs that then fuel our economy, because those higher paying jobs means you can buy your kids iPhones. Those are the kind of things that are helpful. Manufacturing, this is another one that nobody was predicting, because we were losing, we lost the battle, right? They were all going over to China and Mexico, and we just couldn't compete anymore, particularly in the Rust Belt, and in cities like Rockford, it's been a challenge. But here's what's really interesting. A lot of different factors have come together to where the cost to manufacture goods has actually come down dramatically in the U.S., and it's not much more expensive than China, Mexico, or India. And you say, how could that be? I mean, is that because we're not paying our people as much as we used to? No, that's not the case. Really what it comes down to is technology. We have been able to evolve from making widgets to making much higher technology-based manufacturing, and using technology to get more productivity out of our workers. So a worker here in the United States accomplishes a lot more than you do in, say, the developing world. So this is it's pretty interesting. Again, we are now in a place where we can compete, with even the low-cost providers, and certainly becoming a lot more competitive than, say, Europe and Japan. Now, what's the side effect of that? Well, the jobs are coming back. Whirlpool had moved to China, and they just came back to Ohio recently. Lenovo, I don't know if that's a name you're familiar with. A name you would be familiar with is Big Blue or IBM. So they used to make PCs, IBM did, and then they sold off that division to the Chinese, who quickly renamed it Lenovo. And the Chinese decided that it was cheaper to make those PCs back in the US as opposed to making them in China. So you have a Chinese company who's making PCs back right here to the United States. General Electric recently moved back from both Mexico and China to Louisville, and there's just a huge boom going down there. BMW, so we talk about foreign cars. Well, is BMW a foreign car, or is it an American car now? Well, they're making it here. So the good news is it's driving jobs here. So that's really a pretty phenomenal sequence of events. Who would have thought that jobs would be robust and fuel costs would be coming down in manufacture? We'd be, again, leading the world, but that's what's happening. And it's good growth. Again, it's not going gangbusters like in the dot-com era, but the good news is that sustainable, compoundable growth is the kind of things that the stock market likes, and that we all get comfortable with. So that's the U.S. What about overseas? Well, we are ahead of the curve. We didn't fall as far, and we started recovering faster in the United States. But it's coming along in the United States or the overseas as well. When you look at what's going on in foreign markets, three main phenomena that are good things. First of all, now we see Europe and Japan and a lot of the rest of the world dropping interest rates. They were a little behind us. They didn't drop them as fast. They'd always been inflation hawks, and they woke up and realized that if they didn't drop them, their economy was going to be in peril, but furthermore, that they actually had the risk of deflation. So we are now seeing a lot of the foreign countries doing the same sort of things that the Fed were doing a few years ago, which is really fueling their potential growth. The second thing is that the fact that we here in the United States are growing faster, we have more money to buy their stuff. And the dollar has become quite strong. And the good news, like I like wine, and I've been buying French wine like crazy lately because it's a lot cheaper than it used to be. So furthermore, if you buy a foreign car, there's an advantage. You get more car for the same amount of dollars. So that extra demand, it's good for consumers here because we can buy stuff less expensive, but it's also good for the foreign markets because they're getting additional sales growth. The third thing is really structural reforms. Believe it or not, they're getting their act together. Now, who would have thought that? I mean, go back a few years and Greece was complaining because they didn't want to work 30-hour weeks. That was way too much. Well, guess what? They're working longer. They're actually they're making the cuts that they should have made a long time ago. They're being a lot more reasonable. And it's actually starting to pay off. So these are three phenomena in the developed economies that the good news is they've been a little behind the U.S. as evidenced by maybe some of the lagging returns. But as their economies come along, they've got some catching up to do, and I think there's potential for that. When we switch to the non-developed markets, China. The big news there is that, yes, they are slowing. They were growing like 10 or 11%, but that's not sustainable. They were growing because they just kept basically exporting stuff. And what's happening is they're moving to a slower growth sort of phase, but it's a more sustainable type of growth. They're actually starting to buy their own stuff. So in the past, it was they just kept exporting stuff to us for us to buy and banking the money. And in fact, it was just a couple days ago, for a long time, they were taking all that money and just buying treasury bonds. Well, now, Japan is the largest owner of our debt. So they're starting to actually spend some of it themselves. And that creates a more sustainable growth model for them. And it also is just kind of common sense because they got over 1 billion people. And the interesting thing is the Chinese, as an example, are really brand conscious. They like the brands. They love the iPhones. So, as their economy grows and their middle class grows, that will allow them to buy more of our stuff. When you look in the other emerging countries, it's actually really a favorable outlook there, and it's mostly a demographics thing. In Europe, people are getting quite old. In Japan, they're getting quite old. United States, we're not getting old because we are continuing to import people from down south. But on the other hand, in a lot of these other emerging countries, they have a lot younger population, which means you got a lot more people to work and a lot more people to buy and a lot more people that want to buy first homes and cars and so on. So that's something that will continue to help in the emerging markets world. All right, so that's kind of the overview of what the world is looking at, like from an economic perspective. Now, the question is, okay, what does that mean to you? How does that translate back into dollars and cents and returns? So in the last few years, we've talked about how we think about the future and market returns and what expected forward-looking returns are. And I'm not going to get into that whole discussion again because they'll put you to sleep. But what I do want to do is just kind of at a summary level, we're not just saying making things up, and we're not just saying, well, what happened in the past is going to happen in the future, but rather what we do is we look at certain metrics and statistics and accounting data to say where are we at today, and that does inform a little bit about what the potential is going forward. And those are things like valuations, yields, interest rates. One that we always tend to go back to because it's a kind of a staple is the PE ratio. Now, what is the PE ratio? This is a measure of how expensive or how cheap stocks are. So how do we calculate this? It's the price of all the stocks, so what the global markets are willing to pay for stocks, divided by the earnings or profits that those companies are making. So it's the price divided by the earnings. So when you have a high number, stocks are expensive. When you have a low number, stocks are cheap. So, where are we at today? Because this, by the way, why is this relevant? When stocks are cheap, they tend to do above average going forward. When stocks are expensive, they tend to do below average. Well, where are they at today? They're about normal. You know, if you look at U.S. stocks, the current level is 16.2, and historically it's been 16.6. So it's not dirt cheap like it was 5 years ago when we were having these meetings and saying, wow, we're expecting really big returns. No, that's not the case any longer. But they're also not super expensive. You hear about people talking about all-time highs. Well, but the profits are also at all-time highs. So when you compare the prices to profits, they're actually quite reasonably priced. It doesn't mean they won't go down, and they certainly could rally a lot, but it really says, you know, we shouldn't be sitting there, you know, waiting for the big crash just because we're at all-time highs. Now, it's a little different story when you go overseas. When you look at, say, the developed foreign stocks, you can see that the current level is 14.2 for PE, which is about 23% on sale compared to history. And then emerging markets is even more favorable. The PEs are 11 compared to 16, or about 31% on sale. That doesn't mean, you know, they can be sale on the blue light special. They mark it down further sometimes. So it doesn't mean they won't go down. But what it does mean is when the stocks start out at very reasonable levels, there's less risk and there's maybe more upside potential. So that's just one example of a forward-looking return metric that works into our model. And there's a whole bunch of others, but just kind of cutting to the chase. You know, what does the stock market look like, U.S. stocks? Well, you know, we think, you know, based on the model, based on things like PE, your large U.S. stocks have about an expected return of about 9% right now. Now, when that's the big blue chips, your S&P, your things like small cap are a little higher. They always tend to do a little bit better. Now, you may look at this and say, well, you know, Tom at the beginning had said stocks make over 10. S&P has done over 10. But keep in mind, inflation today is a lot lower than it's been in the past. Inflation is between 1% and 2% today. So you making 9% when inflation is only 1 or 2 is actually a really nice real return or after inflation return. So it's still pretty favorable in that regard. Foreign stocks. Now, remember I said the foreign stocks tend to be fairly cheap right now. So what does that mean? That means the expected return on foreign stocks is a bit better. So if we think about your international large foreign, about 10. Okay, so about 1% better than the U.S. in the long run going forward, just based on the current levels. And when you get into things like small cap and emerging, better yet. Now, that's stocks, but what about bonds? Well, we know right now bond rates are very low. You know, if anybody see, you know, go buy a CD lately? You know, in some countries you have to pay them to hold your money now. I'm not joking. So the rates are quite low, and by the way, that means when rates are low, you know, it's a little more risky than normal, because if they raise the rates, you know, the value of the bonds can decline. So what should you do? I mean, they're so low and the risk is higher. Well, you still should have them because they're important parts of diversification for most investors. But you just got to go into it understanding the expected returns are lower. You know, how much lower? Well, you know, in the long run, we think 3 to 4%. Okay, so where historically it's been more like 5 or 6%. So that's just the reality. Now there's some other assets like the commodities and REITs. Again, last year there were bookends. REITs did great. Commodities did pretty miserable. The long forward-looking return about 6.5. So historically, these commodities and REITs have done a lot better than this, but they're REITs and commodities both tend to have some relationship to interest rates and inflation. So since inflation is low and interest rates are low, commodities and REITs tend to do less good over time as well. So those are kind of the forward-looking expected returns. Now, you know, you put all this together, what does it mean? What does it mean to your portfolio? You know, in a sense, what we need to do is average all these component parts to get an idea of what, say, the next 20 years could look like. And if we go back to that, you know, 70-30 or Savant 70, and you know, you may be more aggressive or more conservative, but we just kind of start with this because, you know, average client is about 70. The expected return is about 8%, so not so shabby. You know, I mean, it's maybe a tad less than the long-term historical, but it's certainly better than what we've seen over maybe the last 10 years. So 8% isn't so bad, and if you go to all stocks, about 9.7, because where's that come from? Well, we said, your big blue chips maybe 9, your international maybe 10, you kind of average them out about 9.7. And then, if you're not one of those two, you're one of the other portfolios. So when you kind of put all that together, you get a range of returns. What does this tell you? Well, it's a fairly steep curve right now. Sometimes you get paid more for stocks compared to bonds, and sometimes less for stocks compared to bonds. Right now, with a quite steep line, you can see, say, the Savant 20 is less than half of the expected return of stocks. So there is a bigger than normal premium for stocks over bonds. So some people may be inclined to be a little bit more aggressive in this type of expected return environment. Okay. So that's the long-term outlook. Now, remember I said in the beginning that some new technology that was a kind of a derivative of the financial crisis. Anybody recall the whole stress test discussion? The feds, the banking regulators came out with what they called stress tests, and they had these big banks that were quote unquote too big to fail. What they did is they really wanted them to use statistical analysis to say, what if this, what if that, what if the market crashes, what if and really see how sound these banks were, so that they could do a better job of deciding which ones survived and which ones got to go to FDIC heaven. Right? So that was a stress test concept, and that same technology that came out of the banking industry, is now available, that we've been able to license some of that. And what it does is it's not really a clear crystal ball, but for the first time we can say, well, what if this or what if that? Because clients obviously say, yeah, but what if this happens? And we never really had a good answer. And we still don't have a perfect answer, but with some of this technology, we can start having, some opinion around what different events in the economy or the markets or globe and how that might affect your portfolio returns. And really what it does is it takes a whole lot of statistics, trying different scenarios, and answers questions like, what if the 10-year Treasury goes up to 4%? Or what if oil rallies back? Or what if China has a great big recession and causes other countries to struggle as well? So to give you just kind of a little case study here, because one of the questions people always say, well, interest rates are going to go up. What if interest rates skyrocket? Now, what would that be? Well, if you took something like the 10-year Treasury that was at about 1.7 and say, well, if in the next 12 months, what if it goes up to 4%? Which would be a huge, from a historical perspective, that'd be a huge increase, about a 2.3% increase in interest rates. So unlikely, but what if? Well, if that happened, this stress test technology allows us to say, what would the likely inflation rate be? Well, it would be about negative 1.6, so actually deflation. Well, what about gold prices? Well, it would drop about 13.5. Well, what about the value of houses? Well, no surprise, if interest rates go up, people won't be able to buy as many new houses, and so the value of homes could fall further. But more importantly, what would happen to my portfolio? Now, you got to take this, in the context that we're only asking about this one variable, what if interest rates go up? Because the world isn't quite that neat, right? Interest rates go up, and then this happens, and that happens, and that happens. But if we just isolate that particular factor, interest rates go up, the Savant 70 would likely would do about 3.2%. So not great, but certainly not as scary as some have assumed. So the fact that interest rates go up isn't necessarily a bad, horrible thing, because actually you end up making more money on your bonds going forward. So that's one example of a scenario. 10-year Treasury rises. But there are other ones that are good. Global growth, higher commodity prices, European QE, the whole monetary easing, if that actually works over there. Those are all things that could cause the Savant 70 to do quite well. Of course, we know there's bad scenarios, Middle East, or Ebola, or China recession, trade war with Russia. Those could all be things that, at least in isolation, particularly something like a China recession, could be challenging. So those are all kind of interesting. Still, not a prediction of sorts. But instead of just saying, that the return is going to be 8% over the long run, we can now get a little more granular and reduce the fear of what people fret about as they think about their portfolio. And yes, you say in the long run we think about 8%, but in the short run, these are some examples of things that could happen that could cause those returns to vary plus or minus. Now, what exactly will happen, we still don't know, but at least this gives a little bit of perspective that some of the things that people think are scary oftentimes aren't really quite so scary after all. So that's kind of the overview, and just to kind of summarize my comments, when we think about the outlook, stocks still seem reasonably priced. They are either normally priced or a bit cheap, depending on if you're looking at US or foreign. Second of all, bonds and alternatives, they're still important parts of the portfolio, but we don't think they're going to do as well going forward, and they may be actually a little bit more risky than we've seen from bonds in the past. And then last of all, in the short run, it's always uncertain. So we'll tell you for sure next year what happened in 15, but that's as much as I can tell you for now. So thank you for your time tonight, and I'm going to turn it over to Tracy, who's going to switch gears completely and talk a little bit more about the financial planning side of how Savant thinks.